Hello and welcome to our new capital gain taxation guide. In this video, we clarify the Romanian capital gains tax obligations for individuals and how those tax obligations must be correctly fulfilled. We tackle the most common questions and offer useful tips to help investors handle these tricky rules with ease. More and more people are turning to investments in the stock market, forex, and mutual investment funds. Stock markets have been on continuous growth for years, and investors are always thinking of generating as much profit as possible. When generating gains from stock transactions, investors automatically worry about the applicable tax treatment for such gains, as well as the tax reporting liabilities they have towards the authorities. How to declare the capital gains taxes to Romanian authorities. It should be noted that, if you sell the shares through a Romanian broker, the tax reporting obligation stays with the brokerage firm. In this case, the broker has the obligation to calculate and withhold the income tax due and provide you, at the end of each tax year, a portfolio report. The applicable income tax rates are also different if you transact the shares through a foreign versus a Romanian investment broker. If you invest through a foreign broker, the standard income tax rate of 10% applies. While if you invest through a Romanian broker, there are two different tax rates that may apply, depending on the period of holding the shares. If you hold the shares for at least 1 year, the income tax rate is 1%, while if you hold the shares for less than 1 year, a tax rate of 3% applies. Taxation of capital gains from the sale of foreign shares. Capital gains from transactions with securities issued by non-resident companies, meaning shares of foreign companies, must be declared by each individual through the annual tax return. There is a difference in applying taxation on capital gains from sale of foreign shares versus those derived from the sale of Romanian shares. More precisely, this applies when it is required to avoid double taxation in those cases when the income is taxed in the source country as well. Specifically, when completing the tax return, you must specify the method for avoidance of double taxation and the amount of income tax paid in the source country. The tax treaty signed between Romania and the country of source establishes the method for avoiding the double taxation of capital gains. This can be either the exemption method, in which case the income will be exempt from taxation in the country of tax residence, if taxed in the other country, or the tax credit method. If the tax credit method applies, and at the same time the tax rate in Romania is higher than in the source country, then you will only have to pay the difference between the Romanian income tax and the tax due in the other state. As main rule, the tax credit recognized through the tax return cannot be higher than the tax that would be due in Romania under normal conditions, which is 10% at present. To benefit from a tax treaty, you'll need to prove your tax residency in your home country. Usually, this requires a tax residency certificate issued by your country's tax authorities. To summarize, capital gains taxation in Romania requires careful attention to detail, especially when filling out your annual tax return and managing potential losses. If you're a non-resident, understanding the provisions of the tax treaty signed between your home country and Romania can also save you money. If you found this video helpful, don't forget to like, subscribe, and share it with your network. Leave any questions you have in the comments below, and we'll see you in the next video.